Good day, everyone. Welcome back. I'm Ruben Torrens, and today I'm going to tell you about what happens with your RRSP withdrawals before age 65 or after age 65. When we deposit money in RRSPs during the working life, the idea is what everybody tells you, accountants, advisors, is that you're depositing money and you're saving a higher tax bracket than what you will pay at retirement. And this is normally true. This is normally how it works and how RRSPs are set up. And sounds like a very good idea. You deposit money in an RRSP today, you save 30 bucks in taxes, and then when you withdraw that money at retirement, you pay very little or you don't pay anything depending on your income. The problem is that when you are after age 65, over the age of 65, it's not only about taxation, it's about your pensions, your government pensions, that they can be reduced by your RRSP withdrawals. And when you put these two things together, your tax and the reduction of your government pensions, well, then it's going to be costly. Yes, it's going to cost you a lot more money. So I will try to give you an idea of when this happens. Today on this video, but before doing that, I have to make an announcement. It's official. As of yesterday, I'm poor, so I don't work anymore. Finally, I find two advisors younger than me, which it was is not that difficult, but that they're interested in putting together your government pensions with your personal savings. And this is the part that I couldn't find anybody interested in doing that part and doing the taxation portion. So I don't need to sell any more financial products finally after 36 years. Not selling any more investment, no insurance. So I'm officially poor. I don't have any income, but I'm happy because I can devote my time to retirement pensions, to government pensions. So on this video, for the first time, just below the video in the descriptions, I will publish my telephone number and my email address, and I'm offering half an hour of free consultation to anybody that is interested in knowing more about their retirement affairs. Okay, so let me take you now to the numbers of this system and make sure that this is complex. So make sure that you have a financial advisor. And guys, if you don't, just give me a call. I'm not going to charge you anything. Half an hour is free. You cannot ask for more. And by the way, help me a little bit. Hit the button subscribe and subscribe to the channel. It's free, it doesn't cost you anything, and it helps me a lot. I would truly, truly appreciate it. So let's get into the RRSPs and see what happens when you withdraw RRSP money after age 65. Okay, let's take a look at RRSP deposits versus withdrawals and what happens if we deposit 100 bucks in RRSPs while we're working, and then we withdraw the same 100 bucks once we are retired after age 65. I'm saying after age 65 because at age 65 is when the government pensions starts, especially the old age security and the guaranteed income supplement. So you deposit 100 bucks in RRSPs, and let's say your income is $60,000. If your income is lower than $60,000, unless you have a very good employer pension, stay away from RRSPs. They're not going to do any good to you. If RRSPs are your only means of saving for retirement, stay away from it. Pay the income tax, you'll be better off. But if you earn 60,000 or more, so you deposit 100 bucks in RRSPs, you're deferring $29.65. So basically, you're saving this amount. And if you cash the $100 in RRSPs, well, it's going to cost you this amount, at least this amount, unless you earn a lot more than 60,000. And if you earn, say, $120,000, so well then, because the higher you earn, the more taxes you pay, the higher your income, the more taxes you save when you put money in RRSPs. So you deposit 100 bucks in RRSPs, you save $43.41. So far so good. If you withdraw the money before age 65 and you're still working, you're gonna end up paying give or take about the same amount. But what happens when you withdraw the 100 bucks of RRSPs after age 65? And this what I will show you now is assuming that you have, by age 65, at least 40 years of Canadian residency. If by age 65 you have less than 40 years of residency in Canada, I will say the rule of thumb, stay away from RRSPs because they're going to be very, very costly. Okay. When you withdraw money, there are other factors to take into account. It's like your marital status. So if you're single or you're in a couple, very different. Okay, your income because of the taxes and the tax and pension costs. Are you compromising any pension? So let's take a look. If you're single and your income of retirement, you anticipate that your income after age 65 will be below $25,000 per year, and this is assuming 40 years of Canadian residency. So then withdrawing $100 from an RSPs is going to cost you anywhere from $50 to $72, depending how much you earn here. Like the more you earn, the less it's going to cost you. But if you earn here, let's say $10,000 or $15,000, then it's going to cost you close to $72 withdrawing $100 from an RSPs. This is not a good deal, guys, because when you put this money in an RSP, you never save $50 or $72. So if you're a couple, you will be pretty much in the same situation if together the couple, both partners, earns the maximum of $40,000 per year. If you anticipate that your income will be less than $40,000 per year, then your RRSP cost will be anywhere from $50 to $72 per hundred. And if you are an individual, now, regardless if you're single or married, now you're an individual, and earn any way you anticipate that you will earn anywhere between 80 and 120,000 at retirement, then the $100 withdrawal it will cost you anywhere from $46.48 to $58.41, depending where your income is between these two figures. Okay, so this is very costly at RSPs, and these situations are not a good idea. So what's the alternative? So the alternative is, well, clearly tax-free savings account, because well, they're non-taxable. It's simple. They don't form part of your income tax, and they do not reduce any pensions, or you don't have to pay anything. But the problem with tax-free savings accounts is that they're limited to 81,500 this year. So the limit that you can deposit into a TFSA is pretty low. Probably you have more money, and what do you do? So if it's not a good idea to invest in RRSPs, and you already maximize your tax-free savings account, you have to invest on what we call the open market, either buying mutual funds or stocks, in which case you will earn either capital gains or dividends. And these two, yes, are taxable, and they're a lot more complex. So we will look at each one separately. So let's look at capital gains first. And here is what happens. If your income is, as an individual, as a single person, 25,000 or less, or as a couple, 40,000 or less, so then the GIS, your guaranteed income supplement, can be reduced. But what happens with capital gains is that 50% of capital gains are tax-free. So if you receive $100 in capital gains, you divide it in two, declare only $50 to CRA, because this is where you pay tax, and this is the number of your income tax return that Service Canada will look at in order to reduce your pensions, your GIS or your OAS. So you receive 100, but only declaring 50. So therefore, the cost will be half of what it was in 100, as we saw on the previous screen. And if you have the all-day security reduction, well, same thing happened. So your $100 in capital gains is divided two. You declare $50 to CRA, and then this is a little bit more complex because we're reducing all-day security and paying tax, and now we have the two components. So therefore, you will be paying half the tax rate because you instead of paying 100, you're paying around 50. So it's going to cost you $21.70 plus 15% of your money, but 15% of the $50. Although you receive 100, you pay 15% all day security on $50. So in total, it's going to cost you $29.20. Now, dividends are the catch because dividends are the favorite of every accountant and financial advisor because of the dividend tax credit. But if your uh, guaranteed income supplement or your old age security will be compromised, then dividends can be really nasty. Here is what happens. If your guaranteed income supplement will be reduced because of dividends, and you receive 100 bucks in dividends, so that has to be grossed up by 38%. So once again, and remember on capital gains, you receive 100, but Service Canada will look at 50 only. Well, in this case, you receive 100, and Service Canada will look at 138. And here is what happened. Well, of course, it's going to cost you more. It's going to cost you anywhere from $69 to $72, receiving $100 in dividends. And if you get to the old age security reduction, so $100 times 1.38 is again is $138. So now instead of reducing 15% of the 100 that you receive, they will be reducing 15% of the 138 that you declared to CRA. And this equation is a little bit more complex because you will be paying first a tax of $59.91 for $100, but then you have to deduct $34.53 if you live in the province of Ontario. Other provinces will vary from province to province. This is the dividend tax credit. And to that, you have to add 15% of the $138, which is $20.07, for a total cost of $45.45 for your 100. As you can see, these calculations are a little bit complex. You should talk to a financial advisor, or again, give me a call. You have half an hour of free consultation. So, what happened at the end of the day? In summary, if you are single and your retirement income, you anticipate that the retirement income will be less than $25,000, and you withdraw money, and you will have your guaranteed income supplement at risk. So, and you withdraw money from RRSPs, it's going to cost you anywhere from 50 to 72% of the withdrawal. If you withdraw money from a tax-free savings account, it's not going to cost you anything, of course, because it's tax-free savings account. And if you receive capital gains for $100, well, it's going to cost you anywhere from 25 to 36%, depending on how much income you earn. And if you receive dividends, then the cost will be anywhere from 60 to 96% of your dividend, which is too high. This is not a good idea to receive any dividends once you're receiving the guaranteed income supplement. Now, if you are a couple, well, same thing with the exception of the income. Yeah, if you're a couple and you have an income below $40,000, combined income below $40,000, then your GIS is at risk. And well, the same cost. If you withdraw from RRSPs and tax-free savings account, there's not going to be any cost. Capital gains will be the same cost as a single because it's still dividend. Might be single or couple, but it's still a guaranteed income supplement. And the dividends, well, is unthinkable. You better stay away from it. And if you're an individual that receives and your income, you anticipate that your income will be anywhere from 80 to 120,000, then your old age security will be at risk. And if you withdraw money from RRSPs, will cost you from 46 to 58%, tax-free savings account, nothing, of course. If you withdraw money from capital gains, if you receive capital gains, it will cost you 23 to 29% of the money that you receive. And if you receive money from dividends, it will be anywhere from 29 to 45%. This is the reason why, depending on your income and retirement, and this is something fairly simple to calculate for most financial advisors, uh, depending on your income and retirement, RRSPs may not be a good idea. So if you're single and you earn you anticipate that your income will be higher than $25,000 per year at retirement, but lower than 80,000, but then RRSPs are a good idea. And if you're a couple and you anticipate that the income will be lower than $40,000, and individual income will be lower than 80,000, will be anywhere between 40,000 for the couple and 80,000 individually, then RRSPs are a good thing. They work well. But other than that, well, you will need to stay away from RRSPs, because if not, it's going to cost you a true fortune. It's going to cost you money that you never ever save when you make the RRSP contribution. So I hope you find the presentation interesting and not too confusing. I know that is confusing because it confuses us sometimes, but once again, talk to a financial advisor. You're going to save a lot of money by doing so. And don't forget to subscribe, please. I need your subscription, especially now that I don't work, guys. I don't have any more income. I'm a poor guy, and and I need your subscription to keep the channel alive. Other than that, thank you for watching, and I'll see you in the next video.